The two most reliable metrics for stock market valuation currently still sit at massive overvaluation levels. As you guys know, I talk about the stock market to GDP ratio, which is called the Buffett Indicator, because Warren Buffett, the greatest investor of all time, has said that at any given moment, it's probably the most reliable indicator. It currently sits at 111% overvalued, giving a fair value in the S&P of 2693. Now, you might be hearing that, especially if you're new to our 24/7 channel, and think to yourself, that's absurd. It always feels absurd when things are very, very good. I'm not doing it based on anything besides I made this going back to 1928. I took the average of the historical S&P to GDP ratio, stock market GDP ratio, and that's where we stand. Does that mean the next 5 or 10 years are going to be awful? Maybe not. All I know is, what I do believe though is that the last 5 or 10 years are probably hard to replicate for the next 5 or 10 years. Why? Because guys, every investment is the present value of all future cash flows. But the biggest determinant of your return is the price you pay. And the more you pay, the less your return is going to be. It's just math. If this phone is worth $1,000, if you pay $100 for it, you're going to 10x your money. If you paid $900 for it, you're only going to make 11%. Same phone, same value. What you paid for it determines your returns. It's very simple math. Now, for those of you out there who sit there and say, well, the stock market to GDP ratio isn't reliable because GDP doesn't factor in the money that's made overseas, blah, 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 blah. Fine. This is the 10-year cyclically adjusted PE ratio. This takes in all the earnings of the S&P 500 companies, no matter over the last 10 years, no matter where it was earned, brings it to today's dollars. And guys, we're 114% overvalued. It's even worse than before, okay? Now, I do believe that there should be a higher premium paid to companies today than 60 or 70 years ago. Why? Because 60 or 70 years ago, you basically had to have high capital intensive businesses that involve factories, things like that. So the returns were different. Now, the returns from there were different, but $1 of profit is still $1 of profit. The question is, can you grow that profit faster in the future? Well, yes, you can today, but also there are a lot smaller companies in terms of number of people that have a lot higher market caps. Why? It takes less people in order to make bigger companies. But remember, guys, nowadays it's much easier for big companies to be overtaken by smaller companies that are more agile. So you have to sit there and weigh these balances here and there. I'm not telling you which one to do. I'm just telling you, yes, there should be a higher premium probably paid today. The question is, how much higher of a premium? That's the question you have to ask yourself. Because the big companies that exist today can be overtaken a lot faster than before. Look at Tesla. Tesla's only a 15 or 17-year-old company. I don't remember the number, how old it really is, but it's not that old of a business, and it's taken off the entire car industry. Guys, back 100 years ago, in order to compete with Ford and GM and all those companies, it probably took a long, long time. Tesla did it very quickly. Look at a company like Google. Google's only 27 years old. It's not that old of a business. I remember reading and listening to Bill Gates back in the 90s say, we will probably not be the biggest company in the world in 20 or 30 years, and the biggest companies in the world will probably be companies that don't even exist today. And if you go look at all the major companies, they either didn't exist today, or they were much, 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 much smaller than Microsoft was back then. That's what's exciting about investing. But that's also why ETF investing is such a great idea, because it doesn't make you go guess which company's next, which company is awesome. It allows you to sit there and say, I'm just going to let the market take care of itself and let the ETFs take care of themselves. That's what's so wonderful about these companies. Now, when it comes to the stock market GDP ratio and the 10-year cyclically adjusted PE ratio, it might put some fear in you, but don't be afraid. Only be afraid if you're years away from retirement and you're kind of borderline on how much money you need to retire. Because then I'd be like, hey, listen, I'm not telling you what's going to happen. I don't know what's going to happen in the future. But we are sitting at very, very, very high valuations today. And you see companies flying up and down 20, 30, 40% that are multi-trillion dollar companies in short periods of time. That should be a little scary. It's a little scary for me. But I want you to remember that your job is to focus on dollar cost averaging. And if you want to pick individual companies, just remember, every investment's a present value of all future cash flows. And in order to do well in investing, you must buy out of favor companies, even though the fundamentals are still good. That's what's most important. I have personally lost out on so much money because I looked at valuations at a certain point after COVID and I said, Yeah, the COVID crash was awesome, but valuations are still high. And since then, valuations have gotten better and better and better. So learn from my mistake. Learn from the mistake I made that I'm not going to make in the future as big as before. But remember, I also have 8 or 9 businesses upstairs. I have 1,000 apartments. I have a lot of other cash flow coming in, and my net worth will continue to go up every single year because of that. Not many people have that luxury. So don't mimic the way in which I invest. Just remember to be aware that if valuations are very high right now, if all of a sudden stocks fall 30, 40, 50%, don't be shocked by that. Just be ready to buy more, because every past bear market and every past crash looks like a major opportunity. Every future one feels like a major risk. I want you to view it as the opportunity. I want you to get excited when stocks are down. I get excited when stocks are down. The people in our community get really excited when stocks are down. Because if you love a company at 100 and all the fundamentals are the same or getting better and it falls to 50, you should be buying more. That's the mentality I want you to have. That's the mentality that's made a lot of people very, very wealthy. Now, Warren Buffett and Charlie Munger criticized diversification. I like it. Peter Lynch outperformed the market by owning hundreds of companies. I want to be in the 30 to 50 stock area and even have some ETFs. I'm okay with that. That's the key that's important. You have to find the right investing method that works for you. On our 24/7 channel, guys, we like to do weekly videos, 4 or 5 videos a week, recapping earnings releases, stock market valuation, where the market's at. More focus on news. If you like that, do me a favor. Subscribe to the channel. If you want to engage with me on Twitter, I'm very active there, at EMPaulG. I love putting polls out there, love talking about the markets, love commenting on things. Guys, you're going to have money for the rest of your life. Money is going to be an important factor for you for the rest of your life. This is why we created this channel. I don't care how rich or poor you are, money is important to understand and have a good relationship with. And I want to sit there and be able to teach the things that I've learned and also be able to learn from the people in our community and who subscribe to our software to understand the way in which people think. I just came off of my honeymoon. I went on a high-end yacht experience on the Ritz-Carlton yacht in Mediterranean. I met people who were very wealthy. And the thing I loved about them is I loved having conversations with them about what money meant to them, what money meant to them 30 years ago, 20 years ago, 10 years ago, today. I was one of the youngest people on the cruise. So it was really exciting to sit there and talk to people about what was money doing for you? Where did you view money when you were my age? How did you view money when you were 20? How did you view money when you were 30? How do you view money now? It was really, really awesome. The interesting part is I only met one retired person. Out of all the ages there, I only met one person who was retired. And you know what he said to me? Paul, I can't do nothing. I can't sit around and just do nothing. I got to still be active with my investing and with my business. So even in retirement, he was still investing in things. He was still talking about his investments, real estate. We talked about a little bit of real estate. I even said to him, hey, I have 1,000 apartments. If you ever want help buying apartments directly, let me know. I'll help you out. He was like, oh, that's awesome. These are the things I like doing. So if you want to be able to learn these things more and more, subscribe to the channel, and I'll see you in our next video. Thank you for your time.